I think F&A outsourcing, I mean, it's still, in some respects, a relatively new phenomena. Some of the older arrangements have been around for 20 years, but really it's in the last maybe 6, 7, 8 years that more organisations have considered outsourcing. So let's break that down and look at the various components of what that means. I think initially outsourcing, the obvious benefits are stated around cost, quality and control. So what I mean by that is, from a cost perspective, if you can move work to a cheaper location and access a cheaper talent pool, and you can centralise, consolidate activity, drive process end-to-end efficiency, then inevitably you're going to drive down the cost of your organisation. Now, an organisation can do that itself, or it can get a third party to do it for you, and we'll come back to that in a minute. From a quality perspective, obviously technology can help in part to improve quality, but again, if you've got an organisation that's really focusing on quality as part of its core operational methodology, then you are going to be looking for best practice, best process end-to-end efficiency, and you'll bring tools and methodologies to bear, such as Lean Six Sigma, to really ensure that we're driving out the maximum efficiencies. Now again, an organisation can do that itself, or it can contract with a third party to ensure that those sort of quality improvement measures are baked into the contract, and that there are certain incentives to ensure that outsourcing provider will drive those benefits. The third component is around control, and many people worry in a financial accounting outsourcing arrangement that they're going to lose control of the activity. This really stems from the point of view that accountants naturally are fairly conservative and cautious. They have to ensure that we fulfill our statutory and regulatory obligations, and they want to feel that they can actually control the inputs going into those processes. Now, if you move the activity away from the office next door, the floor downstairs, the building opposite, there's just a tendency to feel that you're starting to lose control. When you give that to a third party, then there's an increasing urgency and nervousness about undertaking that activity. But I think what we're seeing now is when you bring in a third-party provider, you have to remember this is their core business. They've got the skill base to undertake these activities. They've got a contract in place that's very clearly defined what the outputs and requirements of those contracts are. You need a very strong governance methodology in play so that both organisations are talking on a day-to-day basis. You need to ensure that the outsourcing service provider, the third-party provider, is really a natural extension of the client business. To all intents and purposes, the team providing the service within the outsourced service provider is part of the client organisation, and they must have that kind of empathy with the business ethos. So, all that taken together, it provides an opportunity actually for the CFO to improve the level of control in the business. So you're getting an organisation to undertake a large amount of your activity, but in a very managed, controlled way, and in a very structured way that the organisations are working together. And it's enabling the retained organisation to focus then on the high-level value creation activities, which is where they should be, and we started talking about that earlier on. So I just want to now come back to the issue about cost savings and where we are today. So in the last 6, 7, 8 years, we've seen more finance and accounting outsource arrangements taking place around the world. This is inevitably going to continue. Many organisations have moved to a shared service model where they've done their own consolidation and coordination. But now the opportunity to move to a third-party provider is going to provide an opportunity for further cost savings to be taken out. But I think the key at the moment is around organisations within the current global economic, we call it a crisis, but although we are emerging from it in many respects, organisations need to see quick value. Now, when you have competing pressures on the organisation, they can seek to drive that value through some offshoring activity, through bringing in some new technology to drive savings. But bear in mind, they still have to run their core business. and that is taking management time and effort to do that. So by bringing a third party in, you're asking somebody else to take on that activity and undertake it for you, which of course is their core business, so they're good at this stuff. Therefore, you're looking for that organisation to drive benefits, but key now at the moment is to drive benefits more rapidly than if you do it yourself. So I think where finance outsourcing is really going to gain in the next couple of years is the ability of those providers to come up with innovative, interesting, quite challenging solutions which are not only going to strip cost out of the functions but improve quality, improve control, but also bring it in at a certain speed which is very attractive from the point of view of a cost efficiency structure, and helping the client organisation seek real true P&L savings earlier rather than later, but at the same time freeing that organisation up to look at value creating activities and helping business strive for future sustainable success.